everyone, and welcome to our webinar on 9th of August 2017. Hopefully everyone can hear me now. I actually started the webinar. I went through some slides and I realized that you can't hear me. Apologies for that delay. Hopefully it was only 8 minutes time. So I'm Andria, a market analyst here in Hot Forex, and I welcome you in the Markets Correlation webinar. So I will skip some slides. So if you have any audio issues, again, just chat me, and for any questions, chat me again. If I don't manage to explain something through the webinar due to 1 hour limitation, please email to me at webinars@hotforex.com, and Stuart or me directly will reply as soon as possible. So I will quickly read our disclaimer because we already lost 8 minutes. So this material is provided as a general marketing communication for informational purposes only. Nothing in this communication contains or should be considered as containing investment advice or an investment recommendation or solicitation for the purpose of purchase or sale of any financial instrument. We make no representation and assume no liability as to the accuracy or completeness of any information provided, and we shall not be held liable for any loss arising from any investment made based on the information provided in this communication. This communication must not be reproduced or further distributed without our prior written permission. Risk warning: trading forex and CFDs may not be suitable for all investors and carries a high degree of risk to your capital. Trading such a product is risky, and you may lose all of your investment capital. So we went through that. I'm Andria Pichidi. For people that are not there, it's the first time they're attending a webinar. I'm Stuart's colleague. Stuart is our senior market analyst here in Hot Forex. So my mission here, guys, is to help you become better traders. That's like the mission of all of us here in Hot Forex. So let's quickly start since we have lost some valuable time. So we will cover today fundamental analysis, since it's considered to be the most insignificant part of correlation between forex markets and other markets such as bonds markets, equity markets, and etc. So how the impact that this economic data, this fundamental analysis has in the forex markets, how to react in news, the correlation between markets and forex. We'll see some examples of currency pairs, of correlated currency pairs as well, and how you manage to make profit from the knowledge of market correlations. So, sorry if I'm speaking too fast. I will slow down now that we are on the first slide of our webinar, on the first actual slide. Before we start, I would like, actually, I will start with the basic one. So what is a correlation and why it is important for us? So guys, market correlations is when the price of more than two, or actually two markets, are moving together. They can be moved in a positive way, like they are correlated in a positive way, or in a negative way. However, before I go in a more depth of this subject, I would like to ask you how many of you are trading based on the market correlations, or they are able to identify of a market correlation. So just quickly reply in our question box. So not sympathy, not me, yes, Gnocho. Have not done any trading with correlation, no idea how to identify. Good. So we have some mixed questions, some mixed answers. Some of you are based their trading on the market correlations. Some of them never used it before. So that's good. So actually, some of you are actually traders, and you're aware of market correlations, and I assume you're more currency correlations, basically. So John is replying yes as well. Hamed Ali, no. Okay, great. So So let's start. So I'm sure that most of us, and if I'm taking into consideration what I actually thought when I heard market correlation, my first thought, guys, was simply related currency pairs or commodities. I never thought of something beyond that before I actually learn and study this field. So that's what I firstly came to my mind when I heard market correlations. However, market correlation is not simply that, so and cannot be considered as something that can move Forex market. So firstly, I would like to go through a significant factor, as I said before, which is the most important mover of a Forex market in general, all markets, and actually is the economic data and the releases that we're seeing daily from central banks, from other or from governments. So market correlation as well is not just a currency correlation, is a well reading of the economic data and announcement from central banks, and in general a well reading of the market. So a well reading of the market, the well known of a fundamental analysis, is what can be used as a significant technical tool for someone to identify a market direction. So since everything is connected, guys, economic data, politics, currency, each other's, everything's connected, the first thing that you have to do is to study the market. And what I mean by studying the market is to read the data, to understand the economic data that they are released every day, the economic data from each country, in order to improve your trading style and your trading strategy, because the most significant mover of the market is actually those data. It's a fundamental, let's say, mover. So also, you have to understand that you must not treat a Forex instrument like a single instrument. Since every instrument has a whole word behind it. Let's say, for example, let's say Euro USD. I think I put it in the next slide, if I'm not wrong. No? Okay, so just listen to me carefully. Why so important to read the market is because every instrument that you want to trade has a big background, has two words behind it, has two markets. So if we take as a consideration, let's say euro dollar. So euro dollars is an instrument that actually has two giant words behind it. So we have European word behind it and dollar word. We have European market and US market. So if you don't try to understand these markets, these two words, then you cannot claim that you are actually know how to trade dollar USD, euro USD, sorry. So this is what we are called fundamental analysis, is the study actually of the economy of each country in order for you to identify the economy, to identify how this economy, how the US economy or the European economy can affect their currency, how the European economy can affect the euro, how the US economy can affect the dollar. So in order to identify the strength of the economy and therefore the value of its currency, we need to consider some economic indicators. As I said before, some economic data that we are seeing released every single day. So today we'll go through some significant ones, the most significant ones, the ones that affect the markets the most. So some of them are actually inflation rates, interest rates, gross domestic products, money supply, some unemployment data, and etc. So we'll see how this can affect the market. So as I said before, these actually indicators and many others as well, but let's focus to these main ones, can determine, actually can show us the strength of an economy for a country. So these data are actually released by, usually by government or some independent bodies actually, that might collect and analyze economic data, and they publish it to us. So for example, the knowledge, as I said, for this analysis will help you to identify possible direction of the currency. So just take it as it's simple as that, guys. It's simple as the last point that I put. If the economic data show to us that this market, this country has a strong economy, is likely to the economy to get stronger, then there are a lot of possible opportunities for us, particularly for that country. So a strong economy implies that we'll have great returns for investment, so a higher demand of the local currency, so it's likely to see the local currency to be appreciated. So it's likely to have a possible influence in the local currency. So let's skip that and go to more. So let's continue. As I said, we'll see those main reports, such as interest rate, unemployment rate, GDP, retail sales, trade balance, etc. However, you have to be aware, before we go through how they affect the market, you need to be aware that market direction is not actually affected by the actual data, but from the anticipation of the economic releases. So let's say, for example, if we are expecting, if we see, let's say, a negative outcome to come out of unemployment rates. So this is we didn't expect we expected a positive one and a negative came out. So on the anticipation of this economic data, of this release, so before the actual release, the actual data comes out, we are tend to, as the traders, and most of the traders, they are tend to sell the currency if they are anticipated a negative outcome. So this, by selling the currency, but most of the traders selling the currency, then if eventually the price will fall ahead of the data release. So this is what we call market being priced in. So once the traders take action on the anticipation of the economic data release. So, however, let's go. I'd like, before actually I go through these factors, I would like also to underline to you that you have to be careful that you have to be careful actually in the economic report releases. I know that most of you might enter the market during that release. However, you have to be aware that during an economic release, the markets are extremely volatile. So, so there's a big risk due to that high volatility. There's a big risk of the market going in both directions. So that's why most of the institutional traders, the big traders, the big movers of the market, are usually like stay out during the release of the data, waiting for that for that effect to stop and then to enter the market, and they are even closing short-term position prior to the data announcement. That's why we sometimes identify and decrease in the liquidity, because the big players are actually stay out during the economic release, especially if it's something very, very significant, such as the NFP that we had last Friday. So okay, it's not something that it's not a rule, but it's something that I would like to advise you. It's better not to enter during the economic data release is quite risky because there's a high volatility, so the instrument can be moved at any right direction. So you need to confirm your entry by waiting for that, waiting to enter after the data. So let's go to our first and the most important factor, and which is the interest rates. So just a second, sorry. So we have, as I said, this is the most important driver of Forex markets, and this is it's actually released by the central banks and decided by the central banks. So on the announcement of such data, we can see a huge volatility in the market, and or even in the anticipation of it, or during the announcement. So the interest rate of a country is set by, as I said, by the central bank. So in this table over here, I have actually put the major central banks and their current interest rates. So from time to time, they announce a decrease or an increase in their interest rate. So why this is so important? How it actually works? How it works? So we have the central bank of each country. Let's say we have the European Central Bank. So the Central Bank of the Europe is actually lending money to certain banks, to the most important ones, or in general the banks of Europe. So the interest rate is what these banks actually have to pay back to the central bank for borrowing this money. So if we see an increase, a change in the interest rate, and we see actually an increase of the interest rate from European Central Bank, then what that means is that borrowers, and like the other banks that they have borrowed money from European Central Bank, they have to pay more for the money they actually borrowed. So this actually reduces the amount of the money that they have to spend on other things, such as goods and services, and in general other investments that they would like to do. So that has an impact. So this increase of the interest rate has an impact in the economy of the Europe and of each European country itself. So we are interested in seeing an increase or an decrease in the interest rate of the major banks, of the major central banks, because these affect the economy of each country. As I said, if Central Bank of Europe decides to increase the interest rate, then we'll see less money to be spent in other investments and services. So this will impact European economy. Also, you have to be aware that a high interest rate attracts actually investors. So if we are seeing a higher interest rate, that's increase the demand of the euro. Let's say I'm taking as example the European Central Bank. So this has as a result to an increase of demand for the currency, and then the value to rise to see a stronger euro. So as I am mentioning more in more simpler way in the slide, a higher interest rate shows a stronger economy, and so this attracts investors, and then we can see an appreciation of the currency. If we see a lower interest rate, then this indicates this actually the traders actually seen that as a weaken of an economy of the country that actually got his interest rate lower, and so they're afraid of invest in that country. So we'll see a depreciation of the currency. But strictly speaking, this affects this actually this correlation that we see between the interest rate and the appreciation or depreciation of the currency is strictly only during normal market condition. And what I mean by only during normal market conditions is that the market is not affected from something else, such as politics and geopolitics that we have seen today between North Korea and United States. So if the market is not affected by something else, then the most likely behavior of a higher interest rate is an appreciation of the currency, and a lower interest rate is the depreciation of a currency. So that was from the interest rate. Please, if you have any questions, just put it in the box, and I'm sure that some other people might have the same question as well, so you will help each other. So let's continue. I'll continue with the rest of the economic indicators that we've seen, weekly, monthly, daily as well. So we have the first that I have put in is unemployment rate. So unemployment rate is actually simple. It's simple. The measure of the percentage of the labor force. It's actually the people that have that don't have a work. They are unemployment people. So it's logical enough to see that if a country release, let's say, a low unemployment rate, then this means that there are not many unemployed people in the country. Sorry. So this indicates actually a strong economy. So investors, by seeing that strong economy, they get the confidence of that country, so that country has a strong economy. So they want to invest. And as I said before, similar to the interest rates, and in general, the whole idea of the fundamental analysis is when we see a strong economy, we see investors want to invest in that country, and therefore we've seen an appreciation actually of the currency. So this is actually positive for the currency. So also the opposite scenario is when we see a high unemployment rate. So if we see a high unemployment rate, so the people that actually are unemployed have been increased, then this can be seen as a possible weakening of the economy. So this will have a negative effect on the currency, and we'll see depreciation of the actual currency. So we have a question actually. What if the government wants to boost the economy by increasing the interest rate? How do we interpret that? Oh, that's a good question. So as I said before, Dumiso, if I'm pronouncing it correctly. So let's go back to our table over here with the central banks. So a government cannot actually randomly increasing the interest rate. They need to make sure that the economy can hold of it. So like we have in euro. So let's say the European market. The European Central Bank actually has as a target, as you know, the 2% rate. So they haven't boosted up to up to now because they're not confident that the economy can handle it, and the economy is it is strong at the current year. European market and euro is getting stronger, so we've seen many indications of a stronger European market. However, up to their target of 2% is a huge difference. So this will actually cause other problems. So they cannot actually randomly increase up to increase randomly the interest rate. So we'll see indication of other things, of maybe announcements from President Draghi saying that we are seeing a possible increase in the interest rate up to September, or we'll see some indication from the announcement of the members of ECB. So that will not be randomly, surprisingly seeing a large increase in an interest rate. We'll have some signs actually. So you have to it's good to have, let's say, Bloomberg's on your PC and seeing the speech that the members of the ECB and in general the Fed speak that they're from time to time. So they put some indication on whether they are positive of increasing or decreasing the interest rate, and when it's likely to be done, in how many months or the weeks, or let's say years. So don't be afraid of just unexpected, let's say 2% increase in the ECB. This is now it's flat. That's not percent. So you will have some indication. So let's continue with gross domestic products. So gross domestic products is the measure of the total amount of consumer spending, investment spending, international trade, or government spending within actually a country, and over a certain period of time. That might be a quarter, that might be from month to month and week to week. So if we actually seen a higher GDP, a higher rate in the GDP, then this can be considered to be the economy to be actually robust. So the currency will likely appreciate it in value. So this will have a positive effect in the value, in the currency. Sorry. So this indicates actually a healthy economy. So just to underline that actually the measure of the GDP, of the gross domestic rate is always positive. So because it actually measures the growth rate. So if we see a lower result than the last month, let's say, that simply means that the growth rate has been slowed down. So the growth is getting slower, but it's still a growth. If we see a high GDP, so we have the growth of the economy is faster. It's faster. So as I'm saying here, a lower GDP reading will indicate as a weakening in the economy, so there will be in depreciation of the currency. And a high GDP reading means a healthy economy, and seen by investors or by traders as a healthy economy, and indicates on a possible appreciation of the currency. So at this point, I would like also to mention that we have government agencies or investment banks that actually publishing a growth outlook. So the growth outlook is an estimate of what they actually think that the future GDP number will be. So it's an estimate, it's a forecast. So many investors and traders in general use this growth outlook to read that estimate of the future GDP, and then to assume to make to see how the possible way that the possible direction that the particular currency will take. So if the growth outlook is reduced, then we'll see then we probably will see currency to fall, or if we see a growth outlook to rise, then the value of the currency will probably be appreciated. So let's go. We're already past 40 minutes, so I'll try to be quick, and any question will be answered later on, guys, because we are way back. We haven't seen currency correlations yet. Let's go quickly to the retail sales. So retail sales can be considered a significant part of the country's economy. So it's how it's the spending that the consumer actually invests in specific areas. Maybe it will be home sales or any other I don't know, any other spending that they actually do with their extra money. So if we are seeing higher retail sales, then we are understanding that actually in that particular country, consumers have extra money to spend to other goods and services. So this is actually positive for the currency, because once again it indicates a healthy economy. People have extra money to spend to other things than banks or their mortgages or in general their loans. They have extra money to spend. So retail sales have the same fundamentals as home sales. So any strength in the housing data means that people are spending to buy homes, new houses, or so if they have money to buy new houses, this is positive for the currency as well, because we're seeing again a healthy economy. Let's go quickly to the trade balance. So what we mean by trade balance. So the trade balance report actually compares the exports and the imports of a country. So if we are seeing a trade deficit, that means that the imports that this country has done are over the exports. So we are in a trade deficit, so that's negative for the currency. So if we're in a trade surplus, so if we see a country announcing a trade surplus, so this means that the exports are exceeding its imports. So that's actually a very positive thing for their economy, and therefore for the currency as well. So just a quick example, as I said in the last week's example on Friday, it was the very significant data, which was the non-farm payrolls from US. So non-farm payrolls number was expected to fall actually from last time to 102K, but we had a result that was above expectations to 209K. So this means that more employed people have been come out than expected. There were like 20K employed people more than the forecast. So that was actually very positive for the dollar. So that's where we have seen a strong dollar since Friday. If I'm also where's euro dollar, I can see you the chart quickly. That's the one. Let me bring my MT4 in. So if you can see here, this was the time that the NFP data were released, and we've seen nearly 150 pips down. So that was a huge change. So that was a very positive for the dollar. So the dollar got strengthened, and is still quite strengthened quite stronger in comparison with last week. So that was a quick example. So sorry for that. So let's, now that we have done with the fundamental analysis and how the main movers of the economy, such the ones that we have seen, can affect a currency of the country and therefore Forex markets and in general the markets, let's go. Let's see some. Let's go to see some other market correlations that have to do with, let's say, bond market with Forex market, or commodities with Forex market, or equity with Forex market as well. And in general, some examples of these correlations. So as I said, I will pick myself market correlations in when the price of two or more markets are moving together. So we might see more than two markets to move together, either in a positive or in a negative way. So, however, guys, in order to be able to understand this concept, this market correlation, and like apply it without even thinking too much, you need firstly to understand the principle behind market correlation. So why is actually this is happening? Why we have this correlation? So let's take, for example, let's go to our first. I have added some examples in these slides, and then we'll see charts for this major market correlation examples. So as I said before, market correlations can be identified or can be sufficient only during normal market conditions. So let's in the first 2 points, I have added some examples of commodity market in comparison with Forex market, and some equity market in comparison with Forex market. Again, in the second slide, in the second part of our slide, we have a currency correlations. So some positive correlations, and by meaning positive correlation, let's go back to our previous slide, is when they are moving at the same direction. The negative one is when they are moving in an opposite direction. So a positive correlation, the most important, most significant ones can be considered the gold with Australian dollar, or the gold with New Zealand dollar, and also Canadian dollar with oil. So we'll see some examples on our charts for these three. So let's go to our first example, which is gold and Australian dollar, and actually Aussie dollar currency pair. So I mentioned before, and I want to really understand this and to make sure that you apply that, is very, very important to understand why this is happening, why these two are related. So before I explain this example, I'd like to underline that there is a correlation between a positive correlation between gold and Aussie dollar, simply because Australia is a producer, is a very big producer of gold. So any fluctuation on the gold can affect Australian dollar in a positive way. So they are like going at the same direction. So so that's why we're saying that Australian dollar positively correlates with the price of the gold, because it's a producer of the gold, so it exports gold to the global market. So if we actually seen the gold price to be increased, then simply this means that the buyers of the gold from a foreign markets, in general from global markets, then these buyers of the gold, they need to take some Australian dollars, let's say, simply way, I would say in a simply way, they need to purchase Australian dollars in order to buy gold. So so this simply means that we have a more demand in the Australian dollar in order to buy this commodity, in order to buy gold. So that's why we'll see an appreciation of the Australian dollar. That's why we'll have a positive correlation between gold and Australian dollar. So as this example, as I'm saying here, by saying strong positive correlation, this means that a strong gold indicates also a strong Australian dollar. So this example over here was taken like today. It was I took a screenshot of my today's MT4. So in an hourly chart, we will have seen a 77% positive correlation between gold and Australian Aussie dollar today. So, so as you can see, I have put in left and right hand side. As you can see over here, I have split it to a certain periods in order for you to interpret it more easily. So up to 2nd of August, we are in a downtrend. So downtrend in gold. That the same happened to Aussie dollar as well. Then from 2nd of August up to early 7 o'clock actually. So in the morning of 2nd of August up to evening in the 2nd of August, we were in increase. So the gold was getting stronger. So the same movement was happened for Australian, for Aussie dollar as well. Again, that was for 3rd and 4th of August. We were in down, up, down, up. So you're actually seeing the same movements in both instruments. So that's why we're claiming that there is a positive correlation. They are affected by each other in the same way. So that was the first example. As I said, it's simply because Australia is a producer of gold and exports it to global markets. Let's go to our second example, which is actually gold and kiwi, New Zealand dollar. So again, we have a positive correlation. Today, we notice 71% for the last hourly in the hourly chart. So if I don't split the chart into hour or days, then you can see the general trend. We have seen a weakened gold in general from 1st of August to 8th of August, with just a pickup yesterday upwards. However, from 1st of August up to early yesterday, there was a downtrend. The same, we can see the same exactly thing on the Kiwi, on the New Zealand dollar chart as well, in the same time frame. So we have some questions. Okay, so let's continue to oil and Aussie CAD. So oil and Canadian dollar actually positively correlated again at 70% for this in the hourly chart that I noticed today. So what's the background of it? Why this is happening? Because Canada actually affected by commodities, a commodity currency. So a strong oil means a strong Canadian dollar. So actually, this is happening because, as I said, dollar CAD is a commodity currency. This is because the United States is currently actually the world's #1 consumer in oil. So Canada is actually one of the world's largest exporters of oil. So it exports oil to US and in general global markets. So that's why they are quite related. Not quite related, actually, they are related a lot. Like as you can see in our hourly chart today, we have a 70% positive correlation because the Canada is the largest exporter of oil. US is the largest consumer in oil. So the Canadian economy is highly dependent on the US regarding the exports of oil produced that they are likely to be sent in the United States. So as I have also put a pound CAD in this example. So we have Aussie in a daily chart, oil in a daily chart, pound CAD in a daily chart, and dollar CAD in a daily chart as well. So as you can see, During March, oil was in an uptrend. The same happened, no, March to 3rd of April, actually, sorry, up to 14th of April. So from end of March up to mid-April, oil hit $54. So the same movement, upwards movement, happened to the Canadian crosses such as pound CAD and dollar CAD. We've seen an upward movement. So CAD was getting stronger as oil was getting stronger. Then we'll see a decline up to early May. And the first decline was up to the early May, a big decline in oil, nearly $10 down. So we have seen the same decline in those two crosses as well. Then we are in a pickup. Again, we'll see the same pickup in the crosses of Canadian dollar as well, stronger Canadian dollar, strong oil. So I think that's quite simple. Now let's have a look in a negative correlations. So some negative correlations that I have added in this webinar is the dollar yen in comparison with gold, is stock markets in general, along with Swiss franc, Nikkei with dollar yen, dollar index with pound dollar and euro dollar, and some other dollar crosses as well. So let's go through some negative correlations. So as the first thing that I have said, we have gold, which is a commodity, and how this affect the Forex market, and specifically dollar yen in this example. So we have a 4-hour chart of gold and of dollar yen. So we have a negative correlation of 84% in the 4-hour chart for today, that I have screenshot this just today, and 85% negative correlation for the week and for the whole August as well. So what we mean by negative correlation, simply that once gold is going up, then we have seen dollar yen going down. So once gold is getting down, we have seen dollar yen going up. So they have the opposite direction. So this is actually, if you spot the split, the three different fields, areas that I split in my charts, you'll see this this negative correlation. And if you're like a longer trader, a daily one, if you see the general trend, so we have an uptrend since, in this example, was since early July. So gold is in an uptrend in general. However, dollar yen since early July is in a downtrend. Based on the different on the time frames that you are trading, you can spot such correlations, such negative or positive correlations. Now let's go to see some example regarding Swiss franc. So the first example that I have is gold with Swiss franc, and the next one is US index. So we have equity against Swiss franc. So why you need to be aware of such correlation? What's the background of it? So it's simply that because both are like US crosses, I mean gold and dollar Swiss franc, or the dollar index along with dollar Swiss franc again. So any negative report, that any negative economic data that will indicate a weakening in the US economy, any such indication that we have for a weakening of the US economy simply indicates that investors may withdraw their capital from the US stock and put in a safer haven, such as the Swiss franc. That's why we'll see a negative correlation between this let's say, for example, the US index and the dollar Swiss franc. So a negative report out of US economy indicates a weakening on the US economy, so US index is going down. However, we have upwards movement on the dollar Swiss franc, because Swiss franc is getting stronger, because simply investors will withdraw. It's likely to withdraw their capital from your stocks and put it in a safe haven such as the Swiss franc. So they invest in the Swiss franc. So from this example, we have a 95% positive correlation for the last week. So last week, the first week of August. If we are taking into consideration the gold against the dollar Swiss franc pair, so we have a negative correlation last week, and that was just on 66%. Wasn't a strong correlation, but it does happen sometimes. But however, in a weekly basis, it wasn't so strong. However, we have seen an 82% in today's correlation. So we had an 82% negative correlation between gold and dollar Swiss franc today. So you can spot that: up for gold, down for dollar Swiss, down gold, up for dollar Swiss as well. So that is strictly based on the US economy, because they are US crosses. So if the US economy is getting weaker, so gold dollar a pair will go up, because we have a weakening in the dollar. We are running out of time. So we are in the last slide, and we have a very, very, very important correlation, which is Nikkei and dollar yen. So you might not trade in Nikkei, but it's good to have a look at it if you're interested in actually investing and trading dollar yen. So there's a positive correlation. So for this month was 83% positive correlation this month. So if we have seen Nikkei closing up, let's say last night closed down, actually it was in a loss. So we will see the same thing happening to dollar yen as well. So it's good to check previous day's closing, the closing of Nikkei, if you want to invest in dollar yen, because they are highly positive correlated. Many traders are checking Nikkei before entering dollar yen. However, I will underline that this is under normal market conditions. So even if we had a down closing of Nikkei last night, and the most possible scenario is to have the same on dollar yen today, the thing is, like last night we had North Korea and US threatening each other, so that fluctuated our currency pairs a lot. Our market, there was a high volatility, so the market was also going sideways in a shorter time frames. However, if you're a daily trader or a higher time frame traders, such political announcements, political comments in Twitters, etc., that might not affect your trading style so much. However, if you are intraday traders, such comments from politicians and presidents will affect your trading quite rapidly. Actually, if you haven't set a stop loss or a possible profit and close your position automatically. So that was all from me. We ran out of time. I'll try to see some question. So what is my opinion on New Zealand interest rate decision to be made tonight? widely expected will not have any change at all. So if indeed that's the case, that it's happening for the last time, how many times it happened? Oops, sorry, just this. No, apologies for that. Let me see. So my opinion for New Zealand dollar. That was a question for Jacobs. So we haven't seen a change since November 2016. So it's unlikely to see a change tonight as well. So if the forecast is in line with the outcome, will not be any significant impact in the market. So unfortunately, so the price of the currency doesn't necessarily represent its actual value. The case of dollar, okay. So because we are Mohammed Ali and Dubiso, because we are run out of time, well, beyond the 1 hour webinar, I will reply that to you directly in your email addresses. So that was we're in the end of the webinar. So just I will briefly present you our forthcoming webinars. We'll have an introduction to AutoChart. It's a very, very good tool that we have added in our company along with the Trading Central. AutoChart is give you many good signals and presents you the volatility of the market. And so it's good to attend to these webinars. There will be 2 of them, one by me and one tomorrow by the AutoChart CEO and founder. So it's a very good tool to give a try at. So it's a very good tool. Also, we have live analysis every Tuesday with Stuart. You can ask for any currency pair that you want. So Stuart will try to explain the market movement in the pairs that you are actually interested in. Also, we have a webinar of intraday price action strategy, and advanced FX trading strategy, and also another, as I said, another webinar for AutoChart is by me again on 23rd of August. So that's an end. That's where I have to say goodbye to you. Hope you're having a great trading day today, and I'll see you later on in the next week in our next webinar. Good luck today, guys, and that's the end for me. Bye bye.